Morning, ladies and gentlemen. Thanks for inviting me to Denver. I'm pretty excited to be part of a full-day conference on early exits. I'm going to go fairly quickly through this keynote. And what I've done is I've included URLs in the PowerPoint to additional information, mostly on my blog, other talks I've given, articles I've written. So this will be available after to anybody who wants it. We're also capturing this on video, so if you think of something you heard today in this keynote, it should be available in a couple of months on my website and through so you can find the references anytime in the future. You know, when I wrote the book, Early Exits, it really started with my own research on how I was trying to generate higher returns with my venture capital fund and my angel funds. And I wrote the book in 2009, and I was quite surprised by how popular the book has become. And what I'm doing now is as I was telling Peter, working hard to try and get the second edition out. And one of the things I'm going to say in the second edition, and I want to start off by saying here today, is that early exits is not a theory, and it's not an entrepreneurial preference, and it's not a portfolio strategy. It's a macroeconomic observation. So this is something that's happening. Peter and I were chatting earlier, and each of us kind of has the same feeling where we're seeing things that we kind of put into practice. And I think both of us really are just observing what's actually happening out there. And during the mortgage crisis, when I didn't have anything else to do, I just started writing some of them down. And that's what started this whole Early Exits book, and why I'm fortunate to be invited to come and talk to groups like this about what I've learned on how we can be better angels and more successful entrepreneurs. Today, in 2015, I think we've learned a lot. And what we understand now is this early exits trend is actually being driven by the convergence of several other very powerful trends. One of them is the internet. There's a lot of changes in big companies, huge changes in startups. There's a lot of changes, as we're all seeing, in our global economy. And I think there's even some changes in our species that are all driving towards a convergence, creating this powerful trend to early exits being the best strategy for both entrepreneurs and angel investors. I think the internet is, without a doubt, the biggest change in mankind's history. It's accelerated everything. It's reduced the cost of almost everything, and it's dramatically increased access to information. And it's a significant factor in what's driving early exits. Big companies are also changing a lot. One of the things we're all realizing from our portfolios is that big companies, even the great ones, aren't growing very fast anymore. And we've seen the statistics, employment growth in the big companies is actually declining. And what's interesting to me is just in the last 10 years or so, we've been seeing CEOs speaking to shareholders and saying things like, we aren't good at innovation. You would not have heard that 20 years ago. That would have been the end of the CEO, if you get up in front of an audience and say, we suck at innovation. But now the big companies are starting to recognize that and admit that. And what's really fascinating to me is that there's some really interesting research, invaluable research coming out of the Harvard Business School. A gentleman by the name of Maxwell Wessel has written a series of articles. And what he's done for all of us is he's explained why big companies aren't good at innovation. And what he explained was that in this ever more competitive global environment, big companies have had to evolve. And they've evolved to be good at exactly one thing, which is scaling businesses up. That's their core competency. That's what they're good at. And they need to grow. And their other problem is they have too much cash. And what their solution is to that series of challenges is obvious. They're acquiring. They're acquiring at amazing rates we've never seen before. And what's fascinating is they want to acquire earlier than ever before. And what's also interesting and important for angels and entrepreneurs is they won't pay that much more for a business that's been scaled up. Very simply because they're actually better at scaling it up. They actually kind of wish we wouldn't even try to scale it up, because no matter what capital the angels can provide, no matter how good the entrepreneurs are, it's not going to come anywhere close to the established infrastructure that these big companies have to scale things up. I'm seeing a lot of nods in the audience. And so what's interesting is the combination of these big companies having way too much money and not wanting things to be scaled up is very quietly, and without anybody saying it very often publicly, they've become the traditional VC's worst competitors. And I've written a lot about this and these trends, and you can find more information on my blog. One of the things that I'm grateful to Google for, and Google's kind of a modern big company. They're very open, and they're very willing to talk about their corporate strategies. Just a couple of years ago, I was myself surprised by just how early Google wants to do acquisitions. And let's remember, that's one of the largest and most wealthy companies in the world. And Charles Grimm, at that time, was one of the top 5 corporate development M&A guys at Google. He ran a team of people that bought companies. And in a very candid webinar, he said, 90+% of our transactions are small transactions. Less than 20 people, less than 20 million, and that is truly the sweet spot. He surprised me when he went on to say, we do prefer companies that are pre-revenue. Wow, that was an amazingly valuable insight into how Fortune 100 companies are thinking. And this is not unique to Google. This is thinking which is not just in tech, but in every sector of the economy. This is how big companies have evolved. This is how they're thinking. I've actually got a recording of that webinar on my website. I think it's such an invaluable insight into what's happening on the other side of that M&A conversation table. Startups have also changed a lot. And we've all seen that entrepreneurship is exploding all around the world. And today, the best and the brightest young people are much more likely to be working in a startup than they are in a big company. And the capital efficiency of today's companies has increased almost beyond imagination. They're like orders of magnitude more capital efficient than when I was a young entrepreneur. Back when I was starting and running a company, it didn't seem to matter much whether you were building a hardware company or a software company. Everything you wanted to do cost tens of millions of dollars. And that's what gave rise to these large venture capital funds that used to dominate the entrepreneurial finance landscape. Today, we're seeing people build very valuable companies on hundreds of thousands, sometimes tens of thousands of dollars. Peter was talking about Good April. There's a great example. I think $100,000 or $150,000 went to Good April before Intuit acquired it. Amazing capital efficiency. Startups are also being built much faster than they have ever been done before. And that's in part because of the internet, because of absolutely phenomenally different business methods. We're seeing virtual companies built, companies that don't even have a physical presence. All possible because of the internet. So things that we would have thought when I was young took 10 or 20 years are now taking like 2 or 3 years. And there's no question, today in our Western economy, the startups are creating almost all the innovations. And I think what history is going to do, people are writing books about economic history, looking back at this time at the beginning of the 21st century, I think they're going to describe this as a golden era for entrepreneurs and angel investors. I don't think ever before it's been so easy to create such valuable companies using so little capital and to sell them so early for so much money. And I've written quite a bit about that, and that's a popular observation of mine, because I think it's such a phenomenally exciting time to be an angel or an entrepreneur. This one I'm not quite as sure about, and I think that this may be another result of the internet. But one of the things that's pretty commonly believed is that today young people have shorter attention spans. And if you want to get a perception on this, go and ask a university professor how challenging it is today to get students to read a whole book. Or watch your kids multitask, especially when they're telling you that they're doing their homework and they're talking on the phone, they're carrying on 5 simultaneous chat conversations, and they're watching TV, swearing to you, looking you right in the face and saying, of course I can do my homework this way. And what that means to us as angel investors is that they're not staying as long with companies. Everything they're doing is accelerated, put into smaller 160-character chunks. And what is interesting to me is that I see a lot of companies now that are like 2 or 3 years old that are starting to feel middle-aged. The companies aren't as vibrant. They're not as, they don't move as fast. And that's again a very new phenomenon, which people of my generation, I think, are still grappling with, just how much faster things are happening in the entrepreneurial economy. And of course, there's been some dramatic changes in our overall macroscopic economy. Some of the good news parts is that there's never been so much money out there. And another way to say the same thing is interest rates have never been this low in our lifetimes. Now, I don't know whether that's a good or a bad thing in the large context, but I sure know it's a really good thing from an M&A perspective. And what's happened in this very low return environment is there's never been more investors, never been more capital looking for a return. And if you were running a wealth management firm or a financial advisory firm, and you were looking at the landscape of where we've had good returns over the last 5 years, the big bright spot on that map is private equity. And so private equity is growing at an incredibly rapid rate and is a very significant factor in all of the M&A conversations that are going on today. Even when they're not involved, they're a significant factor. So today we're in an environment where there's never been so many types of investors looking to acquire companies. Like entirely new types of buyers that we've never had active in the market just a few years before. And the other thing that's fascinating is the dramatic increase in the number of international buyers. We've been hearing about Europeans coming and buying. The Europeans are aggressive acquirers here in North America. We sold a company last month to a company in Germany, and I had the chance to drink several bottles of wine with the CEO from that company. And he basically said that all of his CEO peers in the Eurozone are desperate to do anything to trade euros for anything else that's valuable in the world. They've got a lot of euros, like most companies. They don't want them. They'd much rather have companies in almost any other, name a country. They're willing to trade euros, which we can, of course, exchange quite readily today for dollars, whatever else we'd like, but they want to get rid of those euros badly. The other fascinating thing for me is the Chinese have finally arrived. It is absolutely fascinating to see how many conversations I've had in a week where all of a sudden, like this in the last 6 or 12 months, the Chinese are back. And I think what's happened there is they've realized that for 25 years, they've been making most of the things that we've been consuming. And then we've been swapping them debt for that. Take this paper, it's good, it's backed by the US government. And I think over there they're starting to realize, hey, don't we have just as much debt here as they do in the Eurozone? So they're thinking exactly the same way. We got a lot of dollars, not earning any interest for those dollars anymore. Let's trade them for things that we like businesses. Phenomenal trade. Very exciting. One of the other things I think is really a positive for entrepreneurs and angels, and it's kind of a non-monetary change in our economy. It's an information change, an intellectual property change. It's the changes in patents. Here in America, we've had the most dramatic overhaul of the patent system we've seen in the last 100 years. Just in the last few years, as we move from a first to invent to a first to file system. And that's just kind of the most obvious change. I think perhaps even a more interesting change is the new rapid approval process, where if you're willing to spend some money, you can get a patent pretty much guaranteed to be granted in a year. Phenomenal improvement over the way things used to be. It's great news for entrepreneurs and for angels. But at the same time, there's been a real significant change in the global attitudes of big companies. And what that's created is some really terrifying risks for small companies that have good patents. And one of the things I talk a lot about is that I believe that the only reasonable business strategy, if you're a small company with a good patent, only reasonable strategy is to sell the company as quickly as you can. Getting a lot of head nodding and thumbs up from the audience. I didn't know this just a few years ago, but you've got companies in your portfolio that you think have good patents. Get them headed towards an M&A transaction before the other thing happens. All of these macro changes are converging to make exits happen earlier. And what's interesting is, usually when there's macroscopic change or big trends, there's some factors that are pushing it this way and some that are counterbalancing it, putting it the other way. One of the things about the early exits trend is that there's very few counterbalancing forces. There's very few things out there that are making exits take longer. And so all of these are accelerating the process, which is why this is such a strong and dramatic trend. And they're all combining to create certainly the best and the fastest M&A market we've had for at least 15 years. The last time it was like this was leading up to the tech bubble, which was a public market bubble in the end of the 90s. But people debate whether or not we're actually in a more active market than we've ever had before in history. So what's happening is the innovation in our economy is happening in the startups. That's clear. What's also better understood now is that the large companies are really only good at one thing. They're good at scaling businesses up. And so the transition from the startup to the growth phase is the M&A process. And what that's doing is it's all combining to create really healthy economic growth in this entrepreneurial sector of our economy. So to say it another way, what's working in the economy today is that startups and young companies are the ones that are doing the innovating. They're doing it rapidly, often virtually, and with very little capital. Big companies and quite a few other types of buyers are buying them early. The buyers are then adding more capital and infrastructure to scale these businesses up. And then the entrepreneurs and the angels are recycling the gains and doing it again. And this M&A transaction is the transition from the innovation phase to the growth phase. That's kind of a macroscopic picture of what's working. I think it's also a picture of the best hope that we have to create good jobs here in America for our children and our grandchildren. That's what we should be doing if we really care about the macroscopic. One of the things I want to emphasize when we're talking about all of these trends and observations is that we don't have the hard data to statistically prove the things that I'm saying here today. What we wish we had is a big database. And in the big database, we would track hundreds or maybe thousands of startups all the way through their founding to their eventual outcome. And what we would do if we had this big database is we track everything that they did, and then we measure the outcomes. We measure whether they had an M&A transaction, whether they failed, whether they did an IPO. And if we have this big database, we can start to do some analysis. This is what people at universities do. And then we determine which strategies correlated with different outcomes. And we would then be able to identify the strategies that resulted in the best outcomes and the highest investment returns. And that would enable us to then start to build some best practices with a great deal of confidence, because we have this data to back up theories, back up the practice. Unfortunately, it's much more difficult than it sounds. And I often have fun when I get together with some of the top entrepreneurship professors in the world. And I keep hoping one day I was going to have an answer to this. We get all excited, we start talking about building this big database. And almost immediately we realize that it would be an extraordinarily difficult data set to capture. And first, because what it would require is it would require tracking each one of these companies through their entire life cycle. And that might average 10 years still today, because not everybody's going to get an early exit done. So if you want to measure hundreds or thousands of companies, you're going to have to wait a long time to the start of this data gathering exercise until you've got any reasonable amount of data to analyze. And we need to track each company, and we need to develop ways to measure and capture their corporate strategies. So, and we have to do that every step along the way. And what it means is we have to include things like product strategy and execution, even HR philosophies, and the macroscopic environment. The quality of the CEO and the board. All of these things also are very significant factors in determining the eventual outcome. And even if we could do this, even if we could imagine, let's say President Obama wakes up, can't be reelected, he's going to do one good thing, he's going to build a database. And let's say he puts, $100 million aside and gets all the university professors, go and build that database, we need that. Even if we could do it, even if we could fund it, the big challenge is the world is constantly changing. And let's imagine, for example, going back in time and imagining that the president in 1990 decided to do this, funded this experiment, we gathered the data through the 90s. I have no doubt that the result of gathering the data through the 90s would have been that the outcomes that produced the best returns, the best outcomes for the entrepreneurs, would have been ones focused on doing an IPO. So again, imagine we built the database in the 90s, we did the analysis, discovered the best practices, IPOs, published that around 2000, told all the entrepreneurs and investors, go build companies for an IPO. Well, of course, we all know that would have been the worst possible advice for the next 10 years. So it creates a really interesting situation. So if we can't do the things that we are trained to do as scientists and economists, how do we learn? How do we learn to be better entrepreneurs and better angel investors? It's really important. We have to figure this out. It's what is going to drive the future of our economy. Well, we can't wait for the academic research. It's certainly going to be decades from now, even if somebody does figure out how to solve a couple of those big problems. So what it means is that we have to rely on anecdotal observation. That's what the researchers call them in the database. And really what that means is learning from case studies. It means, getting together, analyzing a single example, discussing it, figuring out what we can learn. And that's why I think meetings like this are so important. This is when we get an opportunity to share and discuss our observations and our case studies. Exchange ideas on what works in today's economy. To challenge ourselves and each other. To apply our collective observation, our crowd wisdom, to building some best practices that we can apply today. Another thing that makes this work, especially the part of the work that I do around exits, really challenging is that, I'm putting a great deal of my time and resources and, even spending a lot of money trying to figure out how to design and to propagate some best practices on exits. And in part to do that, I've got a small team of people that actually sell companies. It's partly my laboratory, but it's also a lot of fun. And what I hope every time we find a new transaction is this is going to be a case study. And unfortunately, what almost always happens is we get all the way through, we have a great adventure, there's always some great war stories, and then at the end, just before the check moves from the buyer to the sellers, there's this NDA. A new NDA pops up. It's part of closing documents. And in that NDA, it basically says you can't tell anybody anything new. Odd and nodding in the room. We've all been there. And so for me, it's really challenging to find a few case studies that we can talk about. And they're very rare events. They basically happen when a public company acquires a company where the transaction is material. I get very excited when that happens because then the price is disclosed. Then what happens is the entrepreneurs and the angels are willing to talk about it because it's in the public domain. And every once in a while, I manage to capture a really good case study. Every once in a while, some chairman or CEO agrees to talk on the record about what happened. And those are the source of some of the most valuable learnings that I've been able to do about what works and what doesn't work in exits today. And I've got a few of those that I'm very proud of having the ability to share on my blog. So now that we understand that we have to rely on anecdotal observation and not hard data, perhaps the most valuable single point that I can convey to you today is that only 25% of saleable companies successfully exit. Yes. I'm saying that 75% of the time, when the entrepreneurs and investors build a company that could have been sold, we blow it. And we fail to successfully do it. And that's even worse. That isn't the worst news. The worst news is that when a company fails to exit around the optimum time, there's a terrifyingly high probability that it won't just fail to exit and exit later. It will fail completely. So the consequence of not selling at the right time isn't just that you sell later for less. The most likely consequence is you lose everything. So what I'm saying is that when we build companies that could be sold, this is not our total portfolio. These are our winners. These are the companies where the entrepreneurs did everything right, the angels provided the capital, the company could have been sold. Half of the time, there's no exit at all. And of the half of the time that there was an exit, half of those were what I would call successful, and half of them were what I would deem as unsuccessful. Another way to characterize those is happy and unhappy. And all of us angels know what the happy ones are. Those are the ones where we made a reasonable return on our investment. The unhappy ones that we often read about in the press are when we get back less money than we put in, but it's many years later. And this is for saleable, angel-backed, and bootstrap companies. I'm not talking about 25-year-old, manufacturing companies here. I'm talking about the kind of things that are interesting to angels, the kind of things that entrepreneurs are doing. It looks something like that. And I want you to keep in mind, this is anecdotal observation, not hard data. I don't have a database that shows only 25% of saleable companies successfully exit. What I do know is it's far less than half, and probably more than 10%. And saleable itself, that term I use, saleable, whether or not a company could be sold, is a matter of judgment. So, this 25% is not like, accurate within 5%. This is kind of somewhere in the range of 25%. But it's close enough, I think, for us to get the idea across. Close enough for us to appreciate how big the opportunity is to do better. And when I look at the companies that I knew well, that could have been sold but weren't, I see a number of common failure mechanisms. One of them is that the boards often don't realize the company is saleable. And they just miss the whole opportunity. The window comes and goes. A lot of times the board missed it. Nobody even talked about it. Another thing that happens way too often today is the board sits around and waits for an unsolicited offer. Sometimes the board tries, but they don't resource the business function adequately, and the team fails to execute. The exit team fails to get the exit done. And one of the ones that breaks my heart is when the board, the decision makers, wait too long, and they end up riding it over the top, and end up at the end with a smoking break. And I've written a lot about these, and I think one of the things I hope to contribute is to identify and illuminate some of these failure mechanisms in the hopes that they will become less prevalent in our portfolios, less likely to happen to the poor entrepreneurs, and less of a factor in our economy. So what does this mean for you? Well, I think it's clear that we're all still learning to be entrepreneurs and angel investors. And I think the part that we make the biggest improvement in, the part that we're the least good at, quite frankly, is the exit. And because only 25% succeed, I think that being an entrepreneur myself, I see that as the glass half full. I see an opportunity, a pretty easy and obvious opportunity to get that to 50%. So I think we can get it to the point where we only blow it half the time. Which is pretty exciting because that would double the returns in our portfolio. That would mean there is twice as many successful entrepreneurs. That would mean there's a lot more large businesses that are being scaled up to provide jobs for our children and our grandchildren. That's exciting to me if we only failed half the time. And I think ultimately, I don't know when, but at some point in the future, I think we might be able to get something like 75%. To get us to the point where we don't lose tens of millions of dollars just because of a lack of knowledge, because of a lack of skill on what we should be doing to help these young companies transition to the next phase, to be backed by the larger companies with the infrastructure and the capital. So what I think it looks like graphically is something like this. I think if we look at entrepreneurial success and investor returns, we kind of try and graph that against exit strategy. And that vertical axis is either the investment return for the angels or the startup success rate for the entrepreneurs, which is really the same thing. I think in earlier times, a lot of us, and I would even include myself, didn't really have an exit strategy. We'd write a check, we'd hope for the best. And occasionally we'd get what I call an accidental exit. An exit that happened more by serendipity than by good planning and strategy. On the other end of that spectrum, a lot of angels, especially in earlier times, used to think that our job was to get companies going, build them up to the stage where they were VC financeable. And there were some really big experiments done on that. There's one angel group in America that I promised never to name, a big one, and they said that openly for well over a decade. They said, our job is to fund companies, get them venture backed, and then, that's good things will happen. And this group invested an enormous amount of money over much more than a decade. And they finally did an analysis of their returns. And the angel group leaders were so horrified at the results they got with that strategy that they buried the report. And so it was literally, they proved beyond a doubt, they did a great experiment that statistically, at least for the last 15 years, hasn't produced a good return. And so what I believe is that today, we want to maximize our returns. We should be selecting companies that look like good candidates. We should be structuring our investment agreements to encourage a higher degree of success. We should be planning and we should be executing toward the thing that works most naturally in the economy, the thing that's best for the businesses and our portfolios, and that's to look for a return at around that natural period of a few years and start. I want to try and use one of my case studies to illustrate why this is so challenging. And I'm curious, how many people here have heard of a company called Keynote? Oh, good. I wasn't sure. It would have been a lot less fun if you heard about this one. This was a pretty popular transaction in the Pacific Northwest. It was actually a company in Coeur d'Alene, Idaho. But there's not a lot of angel activity or entrepreneurial activity in Coeur d'Alene, Idaho. It's a beautiful place. And they spend a lot of their time in Seattle with the angels. So in Seattle, it's a pretty well-known story. But Keynote was backed by the Frontier Angel Fund, which is kind of a cool example because if you had asked anybody 10 years ago, they wouldn't have thought you could have an angel fund in Montana and Idaho. But they're actually doing pretty well, and this was their first big exit. And they also had backing from a lot of other angels in the Pacific Northwest. Keynote raised about $6 million from angels in 3 rounds. And what Keynote did was a couple of engineers who had worked their whole life on keyboards. And they thought that they had a way to build a thinner keyboard that had better tactile feedback, easier to illuminate. They wanted to build a better keyboard. And what was interesting was that the CEO and the chairman came to an exit strategies workshop that I put on, a full-day version. And before they came to the workshop, they really weren't sure what they were going to do. And one of their directors, a good friend, Bill Payne, said to them, go and spend a day with Basil Peters, see if you can get some perspective on what your options might be. And before they came to the workshop, they were having discussions with the board about financing the company production. You know, the engineers had this vision, just like I did when I was a young engineer. I want to build a big factory and build lots of these things. That was their vision of where they wanted to go. They had quite a few interesting licensing opportunities. I mean, this was around the time that the MacBook Air was just really killing the market. Everybody wanted to fit it. And then there was this, one guy on the board at this point saying, you should think about an early exit. Well, after the workshop, the chairman was sold on the idea of an early exit. And what was the biggest challenge with Vicinian was helping the board agree on the exit strategy. And there was some really loud, long, pretty acrimonious discussion at the board table on the pros and cons of either accepting some of these licensing offers, agreeing on some of the VC financing that was being offered, or executing an early exit. And one of the reasons it was a challenge is that there's no data. So there was a group at the board that I was actively helping, saying, we can sell this company. And some of the other board members, smart people, like really intelligent angels, successful entrepreneurs, wealthy people with millions of dollars in there, saying, we can't sell a pre-revenue company. We don't even have a pre-production prototype. It's madness to think you can sell this. Show me some data to support that this might even be possible, let alone it's a good idea. And of course we couldn't. There is no data. And it took months, the better part of a year, to get a consensus at the board table on what to do. And so the core company was kind of stuck. It didn't know which direction to go. The management didn't know what to do. They didn't know if they should be raising more money. It was a pretty horrible time, just trying to get a consensus on a strategy. And of course, because I'm telling this story, what the eventual outcome was. You know that they did complete an early exit. And what I think would be fun is to remind you that this company still didn't have the pre-production prototype. And one of the reasons they did 3 rounds, by the way, is they also did 3 pivots. So all of us individuals know painfully that the pivot means the money that you invested, that's gone, and now we need more money. Now we have a new idea. So this was really idea number 3. But they couldn't really, they had like just a few keys you could kind of push with your forefingers at that point. And of course they had no revenue because they didn't have a product. So they did have some interesting patents. One of the things they did well is they aggressively patented their ideas. So I'd like to just do a quick quiz here. What price did we sell the company for? And what I'm asking for is the gross price. What was the total value of the company? Don't worry about transaction fees or anything. Shout out a number. What did we sell it for? Anybody want to guess? 25.
60.
30. 36? 30?
200.
It was 30. $30 million. And you know what's interesting? I love doing this experiment. Sometimes in larger workshops, I actually have some examples, some of these case studies, and I give people in the workshops the data that they need to do the estimate. And then we'll often break into groups. We'll spend an hour doing this. And then we'll have people come back and we'll report what the data was. And if you average out the numbers, it's uncanny how good the angels are if we use crowd thinking to come up with a valuation. It's usually within 10%. There may be a whole other research area here showing that if you just give the angels 10 minutes of data, they talk for 10 minutes, you can get to the valuation pretty accurate. And this is interesting because, of course, there's no fundamentals here. There's no way to say, this is X times something, because there's no revenue, there's no financials. It's purely an intellectual property transaction. But yet, you guys, yes, really well, impressive. There's a lot more from this case study. It's a really good example. The chairman, Johnny Humphreys, was very generous in sharing some of the war stories in some videos up on my blog. One of the things I really like about this one is that this is so rare to have this, he told the story of how we got the price to go from 20 million to 30. And he described the reactions from the buyers who were offering 20 when he went back after we had some long discussions. he went back and said it's 25, and they said why, and he said no reason. Of course, the revenues hadn't improved. And there was howls of protest, and then we had some more long conversation. I really liked John. He had nerves of steel, or whatever other analogy you want to, anyway. He was a fearless negotiator. He finally went back and said 30, figuring that everybody would drop out. And we were right, there was one bidder left at 30. And that was a famous company, Synaptic. And you probably see Synaptic drivers on every Windows machine that you have because they run all the touchpads and keyboards. I mean, they're the biggest in their field, about a $500 million a year. NASDAQ was the company. Paid $30 million in cash. Very successful transaction. And to me, the interesting thing about this is, what if the board conversation had gone in a different direction? We'll never know what would have happened if they accepted the venture capital financing. We'll never know what would have happened if they accepted the licensing. And this is what makes angel investing very difficult, very exciting, I think. And it's, of course, it's the same for the entrepreneurs. This was their whole life in this company. And, so many times we're around the boardroom table and we're trying to make the best decision. And we don't have it. And I say that only 25% of companies successfully exit because I think a lot of the time, quite frankly, we don't make the right decision. A lot of the time, because we don't have the data, because we all bring our own preconceived notions about what works and what doesn't work. We all are influenced by our own previous experiences, which, in a world that's changing this fast, might not be the best guidance for us now. And so this is hard. And I think, again, this is why it's so great to get people together like this, where we can exchange ideas, where you're going to hear some fabulous case studies, recent case studies from this area of companies that have made decisions that resulted in some outcome. Again, they're still case studies, they're not data, but I think that this is how we're going to get better at this. So in summary, kind of wrapping this all together, based on a lot of observations and a lot of discussion, I believe that an early exit is the best strategy for something around 98% of startups. And again, I don't have the data. This is my own observation. I've been watching companies. This is basically all I've been doing for decades. I think about 1 out of 50 companies is probably a better candidate for follow-on venture capital financing. And again, I ran a venture capital fund for years, and I know exactly how many venture capital fundable companies there are in my own little backyard ecosystem in Vancouver. So I think 98% of the time, I wish the entrepreneurs had the right strategy to begin with, or I wish the angels could help them, realize that with an incredibly strong likelihood, the best thing is for the founders and the entrepreneurs, the best thing for the business and the employees, and for the angels, and the big companies, and even for the economy, the best strategy is in the list. I think I might have time for a couple of questions. I know we're running a few minutes late, and I think I'm running a little bit ahead of schedule, so either gong me when the question period ends. But any questions, comments, disagreement? Any VCs in the audience? Anybody want to? Sir?
How do you suggest that a company look for an early exit? A lot of times the company's searching, executing on a strategy, but they don't necessarily have time for the vision. Explore early exits.
It's a great question, and I think to rephrase the question, make sure I got it right. It's like, okay, so I'm sold on the strategy. How do I execute the strategy? How do we do it? And I have a whole day workshop that's being developed right now on exit execution. For years I've been talking about a workshop on exit strategy, which is really a full day version of what we've been talking about here. But a lot of people start off with the same question: well, how do we do it? I'm sold on the idea. Let's talk about some best practices to execute. And it's a whole range of things. This is a whole part of business strategy and planning and execution. But I think one of the things is what you already answered in your question, which is the CEOs are so busy. I remember what it was like. I'm sure a lot of you were running companies. It's kind of business. You wake up every day worrying about the product and the customers and the employees and the shareholders. there's a lot of things going on in the CEO's life. They don't really have, very few of them have the time, the resources, and the experience to do a good job on their exit strategy and plan. And I think this is one of the ways that angels can make a big difference. You know, most of the time the angels are a little bit older. We usually have more gray hair, more scar tissue. I think that that's where the non-monetary contribution of the angels can be very significant to help the entrepreneurs plan and execute the exit strategy. Sir.
Hang on. Can you guys wait for the mic? Because we've got people online that'd like to hear your question.
Sorry, thanks.
You mentioned some companies that you recommend, not recommend a wait around for a proposal and actually initiate and create a proposal. Is that what you mean by not having the board just wait around for an unsolicited? You actually have the company reaching out, making a proposal to the company that would be the acquirer?
Thanks for asking that question. You know, one of the things that makes me kind of crazy is that you still hear people saying companies should be bought, not sold. Anybody hear that out there? People say that? Makes me crazy. You know, it's absolutely wrong, a few of them. You know, it's like saying you built the product and you waited for somebody to knock on the door to buy it. You know, it's that old adage Peter and I were kidding about, you know, build it and they will come. Oh my goodness, how can we say that in the 21st century? It doesn't make any sense at all. And the only thing I know for sure is if you wait for an unsolicited offer, it's almost never good news for the shareholders. And what it means, almost for certain, is you're going to sell that company for a lot less than you could have received if you had designed and executed the process. That's a given. But there's even worse news than that. The way if you're meeting with a single offer, the chance of success, the chance of any unsolicited offer actually completing is only about 25%. And so anybody who's an engineer, 25%. Yes, putting knocks on the door by a company, you've got one chance before it's going to happen. Simple engineering solution, redundancy. You want to sell the company with like a 75 or 85% probability, get parallel offers coming. It just makes sense. So I think that failing to be proactive on the exit is board malfeasance. We should know that. I have a strong opinion about your question. Sure.
How do you suggest that we at Rocky Venture Fund or Rocky Venture Club utilize this insight in our deal selection criteria?
Really excellent question. And I'm very excited, by the way, to see the portfolio returns on the fund that Peter was talking about, because I'm a data guy. You can tell I'm driven. I want to see this in practice. And there's a couple of places in America right now where this is happening. It's happening here. There's been a strong group here in Colorado that's been talking about early exits. I can tell, I get emails, phone calls. You can see a little cluster of a light going on here. And there's also a group in Seattle that's coming along very quickly, and they're getting some really good exit data in Seattle. And I think the leaders in America are actually the Ohio tech angels. You went, who? Ohio what? But John Houston, who I think is a significant contributor to all of this. John Houston used to be the chairman of the Angel Capital Association, a very smart guy. He's actually laid out some real simple written instructions. And what they do in the Ohio Tech Angels is they are clear on what they want to do. They want to fund companies for early exits. They want to get a 3 to 5x return in 3 to 5 years. So when they meet their entrepreneurs, before they let them present, they say, okay, well, here's what we do. We fund companies for early exits. We get 3 to 5x returns in 3 to 5 years. Here's your cap table. Here's what it means to you founders in dollar terms. So they say, take our money, here's what's going to happen, and you're going to have, and usually they're realistic. They don't tell these entrepreneurs they're going to make them millionaires, because they're not. Math doesn't work. They're going to say, you know what, if we succeed, if you do what you said you're going to do, we do what we say we're going to do, you'll have kind of $3, $4, $5 million in. What do you think of it? And then, as it says in the manual, they watch them really carefully. They gauge their body language. Because, of course, entrepreneurs, their heads are doing this continuously when they're trying to make it. Doesn't matter what you say, they're doing this. They really try and determine whether or not this company, first of all, is the company a good candidate for early exit? And then, more importantly, is that what these entrepreneurs really want to do? And if the entrepreneurs are like, I want to build $1 billion company, they say, okay, that's admirable. Good luck, and send in the next entrepreneur on the way out. Because they don't want to back. They're not in the business of unicorn hunting. They don't want to swing for the fences. They're guys who want to make a return. They're 3 to 5X guys in 3 to 5 years, and they're not apologetic about it. They say it up front. Sure.
Yeah. First of all, I've currently exited 5 bootstrap companies, and I've always had seller's remorse. And you have just cured me of that, so thank you for, I feel a lot better about the exits that I've had. But now I've started a company that's a lot more ambitious, bootstrapping it. And how does the company know, how does the company know when it's time to actually think about an early exit?
Great
What's the
question.
timing?
First of all, congratulations. You're a number 5. And I have no idea why you'd have remorse, but if I can provide some additional psychological counseling, please see me involved. Timing is a big part of it. If we could just get the timing right, we'd be over 50%. Timing is the part that we have the greatest opportunity to improve. But you're a classic serial entrepreneur, and you're probably exactly what I was describing earlier. You're working on the business, you're developing the product, you got a million things that are keeping you up at night. And the business process of designing and executing the exit is something that needs some resources. So even if you're a bootstrap, and even if you don't have any investors, I think you could benefit from some outside input, some mentorship. Maybe you have some directors, I don't know. But somebody in your organization has to have the job of watching the market. Someone has to have a job of trying. It's hard. This is hard. I admit this is a difficult thing to do. But aligning the company's trajectory with the current state of the market, extrapolating forward, like you're skeet shooting, and aiming ahead, so you can back up and take the exit's going to take about a year. So you need to start the exit about a year before you hope to have the optimum point in the company's trajectory. And it's very hard. It's just ridiculous. And the thing to remember is, yes, it's difficult. Yes, it's uncertain. But if you try, you're much more likely to hit. What too many of us do is what was on the left-hand side. We just sit there and don't do anything because it's hard. And we let things happen to us. We get unsolicited offers that are too low. Or worse, we ride it over the top and end up with a small deal.
So I wonder what the impact of early stage valuations is, and the changes we've seen. We've used scorecard method here and among others. And in 2010, the average valuation for England was 2.1 million. Last year was 3.0 million. This year we just got results, 3.95 million. So almost 2x over 5 years. So now I'm thinking about Texas or Ohio thinking it's 3.5 over 3.5. Well, now that's got to be like 6 to 10 now. I mean, those valuations are twice as much than the exit test. What the impact of the valuations on this strategy?
It's a really, really important question, Peter, and probably the toughest question that anybody's asked this morning. I don't know the answer. When I wrote early exits, I went up and I tried to buy data on exits. I was young and naive back then. I thought there was somewhere there's got to be a database, at least of the average value of the transaction. And there wasn't. And I said then that I thought it was probably around $20 million was the median valuation. So half the time, I thought it would be less than 20, and half the time it would be more. And then subsequently, by talking to a lot of people, I came to believe it was around 15. And lately I've been saying that I think the median value of a private company in any transaction in America is about $15 million. And just in the last year, we had the first actual hard, semi-useful piece of information came out of Rob Wilbank's group at the Willamette Business School. They do some of the best research on angel investment. What they did was they tracked the data of about 3,000 acquisitions by public companies. And that's, again, it's the only time you get data, and that's not a very representative sample, because it's only public companies. And they showed that the median was 14.8, pretty much what we always thought. So the thing that seems to be pretty constant, doesn't seem to change a lot over time, is that when we sell a private company, we're statistically going to get 15 million is the median. The average is a little bit higher because there's a few large ones, but that's a really sobering number, I think, for all of us. Because, if we are thinking that we're, 15, 10, 20 million, that's what we're going to get out. And you back it up, think about how long it's going to take, what the pre-money valuation is, how much the entrepreneurs have. You back it up, and when you start to think about a $3 million pre-money valuation, it's starting to get to be the upper end of what we can afford to write checks for and still hope to generate a good portfolio return. And it's actually quite troubling to me, Peter, what you're talking about with the trend in valuations. And again, we have a lot more data on investments than we do on exits. Because there's a lot more investments than there are exits. There's about 10 times more investments than exits. Plus, there's a 10-year delay between that investment data, which we're now getting, something good at capturing, and the eventual outcome. And there's no question, we've seen at first regional changes in valuation, first in Northern California, but now we're seeing it nationally. And there's no question there's been an inflation in what entrepreneurs are able to get angels pay on a pre-money valuation. And it's troubling to me because I don't think it's reasonable to assume we're going to be getting more on the exits. So I think that we're in a period where caution is probably the best recommendation I can give, because I don't know how to make this math work. I think we have to be very, very careful. We have to find entrepreneurs that really appreciate that maximizing the valuation during this stage rounds is actually counter to their best interests as well. Do I have one more question? There's a gentleman with the microphone. Stop me, Peter, when I'm running time, please. Sure.
I'd like to return to your thoughts about patents and how to handle that. Rather than discussing a situation where a company already has issued meaningful patents, I'd be interested in your thoughts on situations regarding fresher startups recently filed patent applications. Let's assume for the moment there's an incompetent patent counsel and a recent research has been done and there's a determination there's a recent prospect of meaningful coverage at some point in the future. Be interested in your thoughts on how best to align the patent prosecution process and that whole timeline that can drag on even if one tries to accelerate it with an early exit strategy.
Excellent question. Thank you for asking it. I have lots of conversations with entrepreneurs about patents. And a lot of times entrepreneurs will say that they're not bothering with patents because it takes too long and they probably aren't enforceable anyway. And I agree with you. But where I try and make a difference to them is to help them appreciate that even patent applications can be extremely valuable in an M&A context. And the reason is that the buyers, and by the way, these buyers are smart people. There's no question. People who write these big checks, work in these big companies in corporate development, very smart people. They also know that it's going to take a while. They also know that maybe that patent won't be enforceable. The difference, though, is that they take a portfolio approach. You look at some of these big companies like Google, for example, or Lockheed Martin, all that. They have, I don't know the numbers, but I think it's hundreds of thousands of patents. They have a whole building school of lawyers that just deal with intellectual property. So they take a portfolio approach. Yeah, some of them might not work out, but some of them might be worth a lot of money. So knowing that, and what I know for sure is I have sat across the table many times with buyers talking about patent applications. We don't know if they can be granted, we don't know when. And I can tell that we've gotten them to write bigger checks. I can tell that the price has gone up because of the way that they value those patents. So today, in America especially, and Canada's the same, by the way, we've always had a first-to-file system. You almost have to do it, even if you don't think it's going to work in your business. Because of the first-to-file changes, I think that almost every company thinks they've got some good ideas, has to be at least sending the application. And hopefully, as you said, getting some capable counsel And so I think it's a core competency for entrepreneurs. I think it's something that we as angels should encourage, because we never know if they're going to be valuable in business, but they are certainly valuable in risk.
So your suggestion is commence the process even prior to the favorable outcome, because of the value even of the application. It's not yet.
It's about getting that patent in first now, especially in this new system. And they're certainly valuable. And the ROI on the patents is enormous. And again, I'm generalizing here, but they might cost $10,000 or $20,000 to get filed. But if you're a company like Vicinian, Vicinian's whole value is there. I think they had 8 including applications. And I think about half of them are applications. And that was the full $30 million value. One last question? Ma'am. You got the microphone? Here you go.
So whatever became of Vicinian's technology, did Synaptic commercialize it?
Yes.
Did they make billions of dollars off of it?
Great. It's a great question, and for the founders, I think it's really important. Like I said, that I think it's the right thing for the business. If the business is, I didn't say company, I said business. So that's like the people, that's like the product. Yes, this is a happy outcome. They are manufacturing those designs now. Unfortunately, I can't tell you the financial results because it gets mixed in with this big company's results. They don't report by product line, not publicly anyway. So we don't know how it worked out financially. But the people are very happy. These engineers had this dream of a production line. Now they have a huge production line. They're seeing their designs implemented, and that's almost always the case. If the business is a thing, if it's an entity, if the business and the employee is something we care about, then making this transition to the big companies is absolutely the best thing. Because they don't have any more concern about capital, they don't have any concern about access to the market. If it's a physical product, they don't have any concern about manufacturing it. If it's an online product, they don't have any concern about getting audience attention. The whole future for the business changes dramatically. And if we hold on to them too long as angels and entrepreneurs, we are doing the right thing for the business and for the employees. Great question, Tim. I have a table, and I think it's actually pretty easy to segment companies into the ones that should be venture capital finance and the ones that should be angel finance and really exit. It has to do with a couple of characteristics. One of them is how much capital do you need? These days, angels are comfortable, I'm seeing, just to see audience reaction, I'm seeing angels comfortable in financing companies to about $10 million. Over $10 million, you're starting to get into the venture capital world. And that's kind of the bottom end for most of the venture capital funds. So around $10 million of capital requirements, it starts to make sense. You need that to prove the model, to make the company saleable. Another thing is, how long is it going to take? If it's going to take a decade, if this business is going to need 10 years to prove whether or not it was a good idea, you're probably going to need $10 million because even at a modest burn rate, you're going to burn through $10 million. So if it's a 10-year to prove the concept, to prove the model, or if it's over 10 million, now you're starting to get into the venture capital type of areas. And it also has to be a candidate for an IPO. We're not seeing as many enormous private company M&A transactions in the year. It's another factor that I didn't talk about in the big companies' attitude. They're much more hesitant now to do a $500 million transaction. It's still happening. We read about them all the time. Those guys at Facebook are doing big percentage of the total. It's a whole other conversation. But it's pretty easy, I think, to look at a company, even when it's young, and ask yourself, is this a company that's going to need venture capital or not? Ladies and gentlemen, thank you very much. It's